Hi everyone, welcome back. This is video 3 of our Back to the Basics of Multifamily Investing series. Keep in mind this is for educational purposes only, and feel free to refer back to our disclaimer from our first video, or see below. Now in this video, we will review some current trends on the rental market. Let's get started. First up, let's talk about the US being a renter nation. This landscape has actually shifted drastically since the 1960s or even the 1990s. The long uptrend in home ownership has been reversed. US households have increasingly turned to the rental market for their housing needs. You can see here from 31% in 2004, the renter share of all US households continued to climb fast to around 35% in 2019. That brings the total number of renter households to around 43 million by then. Now, this is due probably to a number of factors. One being the Great Recession, which pushed foreclosures across the board. The long tail effect of that sustained unemployment that then followed is also a big factor. An overall barrier of costs and risks of home ownership, like high house prices, the potential loss of home value, relocation costs, all of these contribute to the continued increasing appreciation for rental housing. Now, when we look deeper into some of these factors, we found a factor of the US population, namely age 20 to 34, as the population with the highest propensity to rent. Based on the US Census, we are seeing around 4 million people turning 18 each year. For this population, renting is an attractive option, mainly because it just suits their lifestyle better. They want to be able to move around easier for whatever reasons, job opportunities, relationships. On top of it, because of college debts and other economic factors, those in this population who actually might want to own a house, unfortunately, they lack the wealth to do it. Now, to build on this theme, this first graph shows a few things. You can see here that from 2010 to 2018, over 60% of renters have at least a bachelor degree. And almost half of them are married, which would include married couples with or without children. Now, as we saw in the previous slide, the highest percentage of renters is this population under the age of 35. To the right, this shows the shift of income of the renter households. While between 2000 to 2010, that net change occurs the highest on the lower end of the income spectrum. That has been reversed in 2010 to 2018 because renters are now actually likely to belong to the higher income thresholds of $75,000 or more. Now, on rental market trends would be amiss if we do not talk about vacancy rates. It is always a risk that comes with real estate investment. Here you can see vacancy rates for commercial multifamily, which is 5 units or more, categorized by their property class based on their qualities. And again, we will review the various property classes on a later section. All in all, while vacancy rates are generally trending low across the board, 9%, less than 9% in 2018, these lower quality properties, so not those high rises, continue to have the lowest vacancy rates, between 5 to 6% in 2018. This is true even at times of recession and post-recession between 2008 to 2012. So that long tail impact, it cements the resiliency of the rental properties. All right, here's some more current rental market insights. We've all heard about the low interest rates during this pandemic, although it is rising again now. Despite that, current rate of home ownership hasn't grown as much as you may imagine. It is still at 66% compared to 69% in 2004. This rate is even lower in the West Coast, with home ownership at 61%, likely due to persistently high prices. So the renter market remains strong. Now, those low interest rates actually do play to our advantage too, as we saw multifamily investment deals. On the rental side, we've seen trends of demand from younger households. Interestingly enough, the rate of demand from baby boomers is beginning to increase now. With everything that's happened in 2020, the trend on remote work overall, there is a massive migration happening towards less expensive states. For example, people from California are moving to less expensive neighboring states such as Oregon. Due to all of these factors combined, we will find that opportunities are actually going to emerge post-pandemic performance as current multifamily owners, likely those solo players, may look to actively sell their properties. All right. Well, with that, thank you, and we will see you on our next video.